So, good morning, good afternoon, good evening, wherever you are in the world. Welcome again to Beyond Bitcoin, a conversation of all things that aren't necessarily focused on Bitcoin in the cryptocurrency and crypto asset world. My name is Derek Graham. I'm the Chief Executive Officer of Portal Asset Management. And with me today, of course, always is my friend and associate, Nitin Gower, who's Head of Digital Assets at IBM. Hi, Nitin.
Hey, Derek, great to be here. This time I'm calling in from Dubai and happy to share that experience with you.
I love talking with Nitin because it's like having an international guest on a daily basis because he's always in a different country. In fact, before COVID, I think you flew 260 days in 1 year, isn't that right?
I did, and it was a great time, 350,000 miles a year. And I had front row seats to all the global evolutions that were happening in every country, and it was fantastic.
Oh, it's terrific. That's I'm envious of that. Not necessarily that many days traveling, but nonetheless. And so, what we do here is we draw upon each other's interest, and the idea is that we'll communicate around the space that we find interesting in the activities of the week. What's important to understand is that we're just having a conversation, and this is not investment advice and not intended to investment advice. This gives us the freedom to talk what we think is happening. And they're the views of us, not the views of Portal Asset Management or for that matter, IBM. And so this week, I'd like to continue with the theme that we spoke about last week, which was not the disintermediation of banks through decentralized finance. It's the disintermediation of wealth. And you might remember last week, we talked about the inability for extreme wealth, that section of the wealth that bubbles up to become 10% of the population that owns 50% of the assets. Historically, their inability to move as the trends have moved over the past. So the example is the landed gentry of the famous Mr. Darcy and the rent taker that he was, and how America's provision of food started to break down the returns that they were getting. But most importantly, industrialization arrived. And when industrialization arrived, the technology associated with building steam trains and railway lines and replicating manufacturing lines was above and beyond the landed gentry. They had no ability, and their wealth collapsed by comparison, and new wealth was generated. Now, we saw that wealth dominate for probably 150 years, the manufacturing wealth. And then, of course, we saw the famous areas of equities and Wall Street and share trading and of course, real estate become the dominant creators of wealth. And if you look around the world, the giants of the world are generating their returns out of investments and real estate. And I would argue now that the arrival of digital assets, the arrival of non-fungible tokens, the arrival of decentralized finance, the arrival of high-speed currencies around the world is not something that these large equity groups and insurance groups and investors, these traditional investors, many of which are north of 60 years of age, are going to be able to adapt to. And that means that this could be the third disintermediation of wealth and the creation of fresh wealth that doesn't own 50% of the top 10%, but starts at the beginning. And I'd like to give this week's prize to Jamie Dimon. Jamie Dimon's an outstanding advocate for Bitcoin, as you all know. And from his position of managing director of JP Morgan, he has again said, Bitcoin is worthless. Quick update, Bitcoin's worth 54,800 US dollars a coin at the moment, and it has north of 100 million users in the network. Do you think here's an example, Nitin, of the fact that transition is not going to be an easy thing for those that are really entrenched in the system?
I don't know. I think every time Jamie has talked about Bitcoin, it has only benefited the community because I think the community around Bitcoin has become a lot more resilient. And in fact, I think an article from one of a correspondent at CoinDesk talked that no one really cares anymore what Jamie has to say about Bitcoin anymore because people have moved on. So it's like the seventh ban that China did that no one really cares anymore. I think it's come to a point that just people don't care about what Jamie has to say. But he's an incredibly smart man. And I would think, Derek, to your point of wealth creation and wealth being concentrated, I think there's a whole element of protectionism of that wealth and that domain. And we begin to see a lot from banking community around the space to say, hey, this is encroaching our space and we need to protect our space. And so I think some of these comments may be alluding to that sort of phenomenon that's emerging in the, in the industry, I think.
Yes, this area of protectionism is a very interesting topic. And the area of accredited investors, wholesale investors, sophisticated investors, according to the 1934 SEC regulations relating to securities, only those people should be able to invest in early stage companies without sufficient prospectuses and disclosures. I'll get to that later, but I think that is an extraordinarily unfair and a barrier to entry for the generation of wealth for generation X, Y, and Z, which I keep being an advocate to. So one of the great things that Jamie said is that, if his customers want to invest, he said, that's fine. He said, people smoke cigarettes. I don't tell them not to. So, I mean, really. So, but what's interesting is I think this also sits again in what we called the 3 Ps last year, the Panama, the Paradise, and the Pandora Papers, with in excess of $11.3 trillion of hidden money. And Michael Casey, who are both friends of ours, Michael Casey turns around, has a lovely heading in his CoinDesk article, and it says, only the little people pay taxes.
Right.
And that is so true, isn't it? And this, you do wonder whether when we see the SEC and whether we see other countries and IMF, and I'll talk about the IMF in a moment, you do wonder whether they're really looking after the little people or they're actually keeping the little people away from this space.
Yeah, I think Michael Casey's last podcast with Sheila Warren and the Wall Street Journal reporter, who actually exposed the Boston and the Dallas Federal Reserve sort of officials who are involved, who actually have to disclose their investments and their activities in the trade only because they have certain asymmetry of that information. They have access to some information that gives them an advantage. And that the topic was not not around wrongdoing. The topic, I think, where he probed was that information asymmetry, which is sort of against the elements of efficient market hypothesis, which states that if all information is correct, then a price of something has to be accurate because the demand supply curves will fix that as long as the information is available to all the players. Well, that's obviously not the case, right?
No.
And so I think the thing that Michael Casey brought up, which led me to think after his conversation on that podcast, is the nature of finance is changing. And to your point, we have digitized finance, right? We have our accessibility through your mobile devices, through your web access, and we have done a lot of things to make banking convenient. But if you look at the banking business per se, which revolves around lending and borrowing and collateralization, that has not changed, right? The foundational elements of, for example, the construct around fiduciary risk and trust and safekeeping of assets, that has not changed. We've digitized it. And the age-old construct of time value of money, the shift that we are seeing now, and has completely shifted. We are seeing, from a risk-free interest to interest-free risk, and that shift has happened because of various economic elements or global macro elements, where the cost of capital, impact, and crypto provide a derived value of scarcity, which is where people are looking at this, right? I think global stimulus that happened around the world because of COVID, leading to various elements that we are seeing now, its spillover effect into massive demand, less supply, leading to inflation. These are all global macroeconomic elements, and that sort of and again comes the information asymmetry, where just a few, because of their access, because of their wealth, are able to take advantage of this more and more, creating that larger divide. So the masses, the people, the investors who all the regulators want to protect, are looking for sort of a vehicle for them to provide this derived value of scarcity, and saying inability for networks to print more provides a certain level of guarantees, in my opinion, and valuation of the token and growth of the ecosystem provides such sustainable growth. So any of the networks, Solana, Cardano, for example, emerging networks, they have a set supply, and it provides certain level of guarantees that because of the inability of the network to print more, like the sovereign nations can do, and hoping the ecosystem grows, that is sustainable growth, in my opinion. And that's where I think a lot of these thesis is. So that is a really, really important shift. Of course, we'll get into new products, new areas, but I want to take a pause. And I think this gels well with what you're alluding to here in context of the 3 Ps that has led to this massive problems in our existing financial system with existing rules. So it's not perfect either, I think.
It's not. And I also think that we're getting to a point where we're starting to lose confidence in the lawmakers. I mean, you've got, Gary Gensler, who turns around and says, again, not in my shift. There's a spill in lane 3. I'm not going to let these cryptocurrency things, see for God's sake, he said, see that they possibly lose investors a great deal of money. And so I have to ask the question again, a great deal of money. Can you give me a definition of that? Like the $11.3 trillion that's sitting in hidden accounts overseas, that kind of great deal of money? In other words, there's an absurd hypocrisy about worrying about whether someone could invest $1,000 in a digital asset and seeing this extraordinary wealth that's hidden through structures and blind trusts in overseas tax efficient countries. And so with that, people do get the sense that this is not fair. Let me invest and let me make my decisions. After all, they can go gambling all night long in Las Vegas and lose everything, and it's totally supported. And so I do get the sense that patriarchal, if someone comes to you and preaches, there's a saying, you've got to preach with clean hands. And these people aren't preaching to us with clean hands. So why not let a new world of digital assets that are run by algorithms and run by communities take over sections of the finance industry?
I mean, Derek, that's actually a brilliant observation. If you look into what we discussed in the past, 80 million people, 70 plus million people from tier 2, 3 cities in India. We talked about Vietnam. We talked about all these different countries. These are the masses. And I think, to your point, that level of frustration to hear this obnoxious amount of money being exposed by ICIJ, for example, it makes them wonder as to where the leadership is. Where are, the leadership of the country is taking all this money away, and what is the role of this common man? So it's not exactly on equal grounds and equal footing where they don't have a chance. They view digital asset as one way. And I think, to me, it's also promoting financial literacy, if you ask me, right? I mean, a few things that we have always debated and fought is underbanked and unbanked in every country. That includes United States, that includes Australia. There's still a quite big segment of people who are not taking advantage of the financial system because of the moats that these systems have created. And I'm actually spending some time in Dubai and I'll share some of the perspective of where some of the progressive jurisdictions in the world are looking at. But if you think about the shift, we have new products. Again, the banking has not changed, the products have not changed. But if you look at some of the elements, I'm going to share some technical terms, and I'll briefly explain what they are, but we'll go deeper into them at some point. You have new terms like flash loans, and flash loans is a really interesting concept that completely defies the time value of money, because you're borrowing for a sub-second response time. So if you look at blockchain is basically
second response. You're getting a loan that you will have for less than a second.
Less than 15 seconds, right? And so what happens is this, right? That in these constructs, so blockchain is about blocks, and each block has a list of transactions to get processed. And all blockchain does is basically takes this list of transactions in a block, confirms the block before it moves to the next block. So you have a time between the two blocks being processed by the system, and you're given a loan that before the next block gets confirmed, you'll repay the loan back. And that's what flash loans are. And then you have something called yield farming, which is a super fast algorithmic way to find the best yield for your money in elements of liquidity pooling or various instruments that can find the best returns for your money. And this is done by a protocol, not going through an army of analysts, an army of sort of financial institutions going in that whole thing. And then you have something called collateralized debt positions, which basically allows you to collateralize much of the crypto assets that you have in demand, and you'll be able to take this asset and put them in a pool and take advantage of flash loans and yield farming. And I think while these may sound very exotic, they're doing exactly the same things, except that they have an element of including the masses, including the network, including the community that it's built upon, and ensuring that if you have an asset that's in demand, then you can use that pool to either liquidate those assets or take advantage of these new instruments. So it's not only addressing the reaching of en masse, but also it's doing a very important job of, I think, of financial literacy. which the existing financial instruments, whether complexity or whether the vernacular around these financial instruments has been enormously complicated, which is the whole point. So I think,
Which
these are
is the whole
defying
point.
these, yeah, and these instruments are defying the traditional conventions of asset classes. And it is important we understand that as investors, as people who are trying to change the world in small ways, that we are trying to do this by exposing these things, is what
Yes.
is the impact of this change on creating larger markets, because we are creating truly global markets, encouraging larger participations, which means increasing liquidity because more people are coming with whatever they have. And you're entering the economy that's encouraging participation, which is really, really important in this case, I think.
I had a conversation today with a fellow whose children listen to our little talk show here.
Oh, that's nice.
And he has children the age of 14 and 17 years of age. And as they get together, and they originally would travel down south to Margaret River and other locations here in Western Australia, they would listen to this. And now they listen to our podcast. And these are teenage kids that are investing in this space. These are teenage kids that are able to mine, that are able to play to earn, and they're able to generate yield. Now, these are teenage kids that are turning around and saying, how can I make some real money, Dad? How can I generate returns? Well, in fact, the dad is very eloquent in this space and understands it, but your average dad wouldn't have any way of being able to answer that. These kids would be well ahead of your average dad. So what's different to running a futures portfolio or a foreign exchange portfolio or a derivatives portfolio, which you would get to use and be a derivatives trader after years of university and becoming a fully accredited statistician? None of that is happening, because these digital natives that understand the concept of yield farming, getting a good return and what the risk might be, because damn, I lost that last one, so I've learned again, I'm now not going to lose the next one, can start to generate return at the age of 14 and 17 years of age. And that to me is an indication of the emancipation of investment that this space provides.
True. And one thing, Derek, if we are attracting teenage as a demographic, I think we've done a pretty good job with this show of resonating with a whole new class of investors. But I'll tell you this, that for my son, who's going to be 17 this month or next month, you have a teenage account, touch your account, and this whole notion of play to earn and NFTs and new asset classes,
yes,
sort of have removed that barrier. That if you understand the space, and this is going to your point of this whole notion of what's an accredited investor versus someone who understands the space but may not have the wealth or not have the earnings to be qualified as that. I think that's exactly the point. This 14-year-old may not have they may understand the space without a formal education, but it's the interest that drives it. They're technically savvy, so they're not worried about messing up the technical elements of the whole thing, and they want to be able to participate in these things. I think that is a fantastic thing. That is exactly why I think these things are meant to be. And I think NFTs in general gives them two elements. One is it preserves their interest, whether it's gaming or collectibles or baseball cards or whatever that may be. But it also allows them to say, I have something of value. It's no longer just a collectible. And as I'm maturing in my life and my life situation changes, I can treat this NFT as an investment instrument or as a payment instrument and move them around the ecosystem because I understand the ecosystem better. And that also
better
promotes
than dad.
That's right. And so I think that to me is a sign that no matter how much regulators and countries and individuals who are in power will fight and label the system, it's the movement. To your early example of industrial revolution and how technology changed mindsets because it was just better to use a rail than use a cart pulled by a horse, for example. It was more efficient, it was faster. And when we did that with transportation, digitization did that with information. And I think blockchain will do that with things of value. So I think technology knows no bound, to your point, I think.
So as I was saying before, this is the emancipation. So for the young, for the newly acquainted with this particular space, the ability to get a wallet, the ability to buy an NFT, the ability to buy a little bit of a token and see how it works, see that first steps, because culturally, that's the only way you can really understand this space and immerse in it. The fact that the establishment has the arrogance and presumption to assume that only wealthy people can invest in this space is really quite obnoxious in my view. It reminds me of Jerry Seinfeld, and Jerry turned around and his son turned around and said to him, "Gee, Dad, are we wealthy?" And the dad turns around and goes, "I'm wealthy, you're broke." so, so another, so in other words, he's saying, yeah, I'm wealthy, but you're not. And so for children to be able to, work out how to be able to invest their own funds, even though they're small amounts, and trade in this space, I think is incredibly compelling. And by the way, for adults listening to this, and you might be trying to think about educating your kids in equities, go for your life, but educate them in cryptocurrencies first, because that will be their future, not equities, because equities is going to be a traditional, I would argue, steadily an old technology methodology of investment, centralized stock exchanges with pretty archaic distributions of stock with limited rights and no smart contract attached to them. So immerse them in this space of what's happening in digital assets. So it reminds me, again, we're talking about being overly guarded by this, or overly protected, or maybe cynically looking at it and going, well, are these organizations really protecting us or protecting their own interests? And we talked the other day about the top 20 country usage for crypto. Now, what we know is the developing countries are investing in this. So the billions of dollars, and by the way, 18 billion US dollars since the 1st of January through to the 30th of September, has been invested in building startup and early stage tokenization offerings. It's a lot of money. And so to us, that means a lot of product coming, by the way, in the future. And to you as listeners should think that means there's an awful lot of new tokens that will coming in the future. Those new tokens could be new business models, new business solutions, new opportunities. So incredibly young space. So the developed countries are doing the investment by and large. The developing countries are doing the utilization. And just bear with me for a moment. I want you to roll through. I'm going to roll through the top 20. And I want the listening audience to think about which developed countries aren't here, right? So number 1 use in the world is Vietnam. Number 2 is India. 3, Pakistan. 4, Ukraine. 5, Kenya. 6, Nigeria. 7, Venezuela. 8, USA. 9, Tonga. 10, Argentina. 11, Colombia. 12, Thailand. 13, China. 14, Brazil. 15, Philippines. 16, South Africa. 17, Ghana. 18, Russian Federation. 19, Tanzania. And 20, Afghanistan. So for you listeners, can you remember exactly where the United Kingdom fit in that top 20? Or where the land of Oz actually fits into that top 20? It's not there. We're not even there. The USA is. It's at number 8. So what that's showing you is that these countries are just turning around and going, let's just jump the entire network of wires and poles and go straight to cellular phones. In other words, let's jump banking and go straight to this.
Though I would say that the United States has joined the ranks of developing countries because of the fact that we still have a long way to go in fixing our infrastructure to keep up with the developed world. And that's, as an American, that's my biggest contention with our political system is we need to build and fix the roads and bridges and everything else. So I think the list 20 that you had, it is a true list of developing countries who are trying to fix their, including the financial infrastructure, Derek. As you know, It still takes 3 days for us to clear a check. We still write checks.
Yes.
We still don't have a real-time payment system. So that list of 20 is all developing nation in terms of infrastructure, both financial as well as the broader conversation on infrastructure.
Here. Can I just ask you, do you actually have a checkbook still?
I do, because banks send you a checkbook. When you open an account, your investment banking as well as your normal bank send you a check And I went through interesting where, like we have a limit of $2,000 a day using Zelle. And I try to send that to a colleague of mine who I bought a car from for my son. And the system detected fraud because I usually don't, you know, I try to send the full 2,000 amount, and I have never done that because I never need to do it. But it was a one-time thing, and it locked my account for 2 days. So my only avenue was to write a check, and they were okay with that. The bank was okay with it, and I was just thinking like, I've just gone back into Stone Ages and working in
Yes.
blockchain world. I asked the guy to open a USDC account because it'd be easier for me if he was in Coinbase, easy for me to just move
Yes.
USDC than dealing with bank. But of course, he was not blockchain savvy, or he didn't have a Coinbase account. So I just wrote him a check. But you see
Yes.
exactly at this point, I wish he had a Coinbase account because I've just sent him USDC, and it'd be that
Exactly.
simple.
Yep, exactly. And so, we're about to open a second fund. First thing that we do is to make sure that we have a wallet so that people can transfer their money straight to the fund. They'll still do all the KYC and the AML, but they don't have to use banks and foreign exchange as intermediaries. And that saves them, by the way, thousands of dollars if they're putting substantial amounts of money into it. But it also opens up that world of cryptocurrency investors that have a lot of cryptocurrency. So just during the week, the IMF released a report, and you know about this. And the IMF provided a report on the cryptonization as a threat to the global economy. And it says, in its semi-annual global financial stability report, the IMF says the adoption of cryptocurrency as a national currency carries significant risks and is inadvisable shortcut. The International Monetary Fund is worried about the cryptonization of the developing world. Now, we just told you the top 20 users of this happen to be in the developing world, so they are worried. In its Global Financial Stability Report, it released on Tuesday, the global financial institution said that cryptoization, the use of foreign digital currency by a country, carries significant risks and it's an inadvisable shortcut for developing countries. The report highlighted 3 challenging transitions for the global economy. And this is where I've got to say I'm quite flattered on behalf of the cryptocurrency industry. And that is, number 1 major risk was COVID-19. So we're right up there in the most important things that are happening at the moment. Number 2 major risk, according to the IMF, is climate change. And of course, in both cases, they're correct. But number 3 is cryptocurrencies. They consider it such a risk. And so the report says that to avoid these risks of cryptization, the report suggests that countries enact policies that could help curtail growing crypto demand, including strengthening monetary policy, safeguarding the independence of central banks, and implementing effective legal and regulatory measures to disincentivize foreign currency use. How extraordinary. How extraordinary.
I laugh at that because I'm surprised. So in the ordering, I don't know why COVID was before climate change. I think climate change is pretty profound, and it should be the single most issue on every single country's agenda, because it is truly something that science has proven. And COVID is, of course, a passing phase, which will be a different pandemic a few years from now, and we simply have to be prepared and do all the right things that we've done. And you're right. I think in some cases, if they have compared, and I read the report too. There are 2 reports that came this time. One was, McKinsey had a report on stablecoin, and the FSB had the impact of stablecoin and CBDC on payment systems, and then you had the IMF reports. But if you think about exactly when we started this conversation, right? Who are you protecting? The Jamie Dimon's comments are large financial institutions when they make the comment. IMF, BIS, these are world bodies who are there to serve the central banks. So their ecosystem revolves around the fiat, the existing banking system. And I wouldn't go as far as you mentioned, as the report mentions, the independence of central banks. I don't know if that's totally true, Derek. I mean, we've seen this over and over again. Central banks, while they're meant to be independent entities, are somehow intertwined with the political systems, intertwined with the economic systems. At the end of the day, a part of central banks' agenda is to do 2 things: prevent inflation and make sure the economic system is there to promote jobs. Well, both are political agendas of the ruling party, whichever entities they're in the country. So I don't exactly think, even though it's meant to be independent, are exactly independent. But IMF, BIS, they serve central banks. They serve the existing financial system. And the armies of people serving in these organizations will sort of be, I wouldn't use the word irrelevant, but they will not have the same impact on the policy structures or all the recommendations, because in many cases, the systems, the trust systems that are building protocols will solve the problem. I don't think crypto world needs an IMF. I don't think crypto world needs a BIS.
Yes.
There are other governing factors that will define the pros and cons, and the masses will vote for its community-driven effort. So I read these reports with that bias to say, hey, you're never going to say anything positive about this. And all of the reports will say they see a lot of potential. And they're close to 160 papers now from Bank of England, from BIS, and from many of these global bodies. They will always end to say the potential is immense of the technology, but we warn against the crypto assets. And I always question that you can't have one and not have the other.
Yes.
The crypto asset is a product of that governance, is a product of that security. You simply cannot throw out the baby with the bathwater, I think.
Well, they're trying to divide it because at the end of the day, it gets back to that old analogy that we used a long, long time ago. And that was the story of when I went to get my solo pilot's license. And I went solo in 12 hours and I asked my instructor how I went. He said, "You're average." And I said, "Thank you very much." And then this 16-year-old boy had gone solo in 8 hours. And I said, "Well, can you explain why?" And he said, "Oh, that's simple. He's not looking for the brake, the clutch, and the accelerator." So the more entrenched you're in the system of driving a car with a brake, the clutch, and the accelerator, the longer it takes to learn how to fly an airplane, which happens to have ailerons and elevators and rudders. This is a different system. These large institutions are looking at this system and they have a program in their brain that runs the same decentralized logic over and over again. Well, that program's not going to solve this because this isn't the decentralized logic of institutionalized funding. And so it's broken. The cryptocurrency industry is not broken. The 1934 regulations and the program is broken. And that's what needs to ultimately be fixed along the way. So by example, I read those top 20 developing countries, including the United States of America. And I'd like to put it in another context. And that is often good meaning people around the world, including myself, have given donations to countries that have had cyclones and hurricanes and famine and all sorts of things, knowing tragically that maybe north of 30%, according to some statistics, of that money is stolen by governments and bureaucrats and other people on the way through. And using microloan technology and using distributed ledger technology, there's the ability now for the world to be able to provide a single woman in India who is selling eggs from her chickens, a loan to enhance her business. And it will be not possible for some corrupt government official to get in the middle of that and steal it. And that's really empowering the ability for that, again, that democratization of wealth, in this case through gift and through the process of philanthropy. Then we've got a country here, they've got an IMF here that says we shouldn't have cryptocurrency and it will impact those countries. Well, I think they're right. It shall impact those countries in a very good way. You've seen that
True.
also along the way, haven't you? You've seen this microloans and concept of how to do that.
So it's interesting, Derek, because there was a project called Kiva. Kiva, it's a decade now, and Kiva tried to do exactly that. You had all these folks who wanted to get the tires fixed off a cart because they were vending, food items and vegetables, and the guy was a taxi driver and he needed to fix his tire, and they just needed like $80 or $400 for loans. And you know what? The payback rate from exactly to the point that Michael mentioned is the small people or the people with less income are the ones paying more taxes. Honest, good people, there's 98% payback rate on these loans.
Wow.
On Kiva platform. And Kiva basically can go as little as, and there are people who want just $20 so they can find a basket so they can carry their tortillas and tamales to market to sell it, and they pay back over 2 months, 3 months. And that's $20, which it's to a Starbucks. in most places. And of course, if you're in Sydney, then you're paying for really good coffee a lot of money. But the
Yes,
whole
yes,
thing
but it's
is,
much better coffee than Starbucks coffee.
that's true. That's true. I am always spoiled when I leave Australia. I cannot drink coffee in the United States anymore. But I think that repayment rate is telling about the same community, the same people. Going back to a previous conversation of tier two, tier three cities and the masses signing up for this, because it provides them direct avenue for not just liquidity, but or direct avenue to marketplaces to raise funds, to be able to engage in borrowing and engage in repaying the back. And there's a reputational
Mm,
element built into it, which is more powerful than them going to a bank, and they may not have an
yes.
ID because they don't have the education. And this one gives them an access through their mobile devices. I think if you look at a project that Cello is another token, as you know, there's a DeFi alliance we talked about last time. There are 100 different companies in this DeFi alliance for good, and they're trying to solve exactly the same problem: is removing all the barriers of wallets and everything else, and letting common people engage in ability to raise money and borrow money and lend money all through a single wallet. So to your point, that's very, very powerful. And it's what's funny is that 30%, which is true, that number is accurate, goes into paying for the same payment company who are charging you 8%, 9% for interchange fee. And then you have the banks who are charging. So for them, whether your money is coming in for good, it doesn't really matter. They still have their fee structures built into it as the global cross-border movement of money happens, which I think is not fair. That if you're
Yes,
spending $20 for a woman in India, she shouldn't get $12. She should probably get the full $20. So
absolutely.
she needs it the most, not the financial intermediaries in between, I think.
So then, is the disintermediation of banks and the disintermediation of wealth potentially linked? Do we have to see
So
banks disintermediate to really also effectively see the breakdown of existing wealth structures to occur? I mean, I know that's kind of insulting and challenging to many that
yeah.
either are a bank or are wealthy or have invested their money. But those of you that might be in your 50s, 60s, 70s and have generated tremendous wealth, maybe I'd ask you just to think about what it would be like now to be 15 years of age or 20 years of age or 25 years of age, and look towards the fact that you're living in a multi-million-dollar home because it's been overinflated in value, and that you've got equities that are trading at price earnings ratios of 40 to 1, where there's just no option to invest. And if you're a young person, this is your option to invest. So the barriers then might be perceived as the banks.
So that's a really interesting topic, and we'll need longer time. But I'll tell you this on that front is two things, right? One is um, banks are institutions, and they do provide a function in a society, as much as we all have in this context, chastised many of these, elements in terms of what banks do and what they're an institution. They provide a function. I think the role of banks will change. Similar to what I have given examples of. Travel agents don't exist anymore. We don't go to a shop and have them print us tickets. We go through, but they still have Expedia and you have Trivago, which sort of craft our experience and they give us the holistic element of travel. And I think banks will be involved in providing the last mile function, whether it's still need of cash or verification, validation, identity verification elements, which will still be the case only because of the system we live in. Not going to change anytime soon. Though I think this is what we have seen the enterprises this week. Bank of America announced a massive unit to say the digital asset is too big to ignore. So we're going to build a research unit
Mm.
around it. US Bank, which is the fourth largest bank in the United States, looked into Bitcoin custody and working with NYDIG, which is a newer company, like just 4 or 5 year old, company, using NYDIG to provide transfer of Bitcoin to account holders in US Bank. FIServ and Fiserv, traditional payment network providers, are involved in moving those structures. Investment banks are providing exposure in different capacities from custody to ETFs. So these is an attempt from large banks to get into the space. Though I would agree with you, the question on wealth, I think that can be changed. The fact that now I'm able to participate in digital economy in some form or fashion, uh, choices that I make, whether I'm investing into Bitcoin and maybe Jamie Dimon is not, maybe secretly he is, I don't know. But the question is that if people are doing it, then if bank becomes a conduit to facilitate that to the larger masses and existing account holders because they already have an account and that account is treated as a wallet, then that to me is banks transforming their role of becoming the on-ramp, off-ramp to the crypto world. And that will only do good because banks still have a lion's share of the accounts that they hold. So
Yes.
the function will change, though I agree with the fact that the wealth effect that we have now, and I'll tell you this, that Warren Buffett and many of the economic pundits have said that this entire global macro situation of inflation eats into your wealth.
Yes.
And inflation and that leads to taxation, and that there are many linked topics around those areas. And I believe that the system we're in right now will certainly have this massive impact on the existing wealth ecosystem. But because we are working on a different wealth ecosystem, depending on who subscribes to what, so you're changing that model, which I think is a very
Yes.
positive thing in general.
Yes, I agree. And it's interesting that the information is there for all of us to see in the simplest of form. We still enjoy seeing the photographs of the old Coca-Cola bottle with 10 cents written on it, or
That's
1
right.
shilling if it's from Australia or the United Kingdom. And this is a $3.30 bottle in a retail shop, or it's maybe $1.50 if it's in the supermarket. What you're seeing there is 1,500% inflation in
That's
your
right.
money that you get paid in, that you keep in a bank. If you were to come from the world of cryptocurrency, where you can get yields of 7 and 8% on US dollar tether, and 5% is easily achieved, and you can invest in assets that you're able to get a yield return on, and that you're able to keep that out of the world of the bank that's charging you $10 a month for the account and transaction fees. And that's the world that you're used to. And suddenly I was to come to you and say, I've got this great new world. It's called a bank. They take your money. You can get it back if you're lucky, because if there's a run on it, you might not get it back. And that money is worth less every single year. And you'd be going, well, why would I do that? Because we're used to it. I would argue we're like, frogs in warming water that ultimately boils. We haven't noticed the temperature change over the years. The fact of the matter is money is losing its value rapidly. What we can
And
buy with it, which is real estate and cars and boats and things like that, miraculously are all going up. Well, are they going up, or is the value of money going down?
but if the 20 countries that you listed, there's one thing in common in all of those countries. Do you want to guess what that is, Tarek?
They don't have solid infrastructure in place.
That's true. It's inflation too. If you look at Vietnam, India, Afghanistan,
Yes.
Pakistan,
Yes.
Nigeria, uh, I think and US too. I think we had inflation, and they can call it transitory persistence, which is the term that was used. I don't even know what that means. That Jerome Powell used in his testimony to the whole thing is that's exactly the point that you're making here, is that all 20 countries have something in common, is just the lack of infrastructure and the fact that when you have inflation, it eats into the value, it eats into your profits. And in many cases, there's a run for those assets because suddenly now people want to be able to get many of these asset classes. So I think there's a lot of truth to what you're saying, Derek, is that, the existing system that we have created, and that will certainly serve itself both in terms of wealth, curbing the wealth growth and creating this new, novo riches of the world who can, my only question then becomes is over exuberance, right? Is there still has to be, and this is again on the crypto side, as a crypto professional that we all are in the space, blockchain space, it's up to us to make sure that the projects that are coming are not all, they all are meaningful work. They're all meaningful projects. Otherwise, you have so many of these asset classes in the market that creates a different kind of problem for cryptos too,
Well,
I think.
that's right. Ignorant exuberance is what we've talked about
That's right.
before. It's a challenging thing because one doesn't really know what it should be capitalized at, because what's its future? And so
Yes.
ignorant exuberance is going to be a natural outcome. So clearly, for those that have arrived by the end of our conversation here, we are evangelists to this space. We're not just evangelists to the opportunity in this space in regards to breaking down institutional control, not because we are at all libertarians. I'm certainly not. Just because the ability to break down some of these institutions and provide the man and the woman in the street the opportunity to learn, educate themselves, and invest in this space, accumulate knowledge that in fact the very wealthy investors don't have, is quite emancipating. And so if you're listening on this, as I said before, we don't give investment advice, but I can give this advice, and I think it's fair to say, Nitin, and that is learn about this space. Go to places and learn about it. Listen to TED Talks. On our Portal Asset Management site, so portal.am, we have a resources section. It's very simple. There's lots of links there to learn from. There's great little white papers on each one of the definition of what DeFi is and non-fungible tokens, etc. And these are places that you can simply learn from, and then you can make your own decision of whether you want to deploy and invest in it. But one thing that is true, whether you do or don't, when you do if you do invest in the space, the chances are you will know more than your stockbroker knows about it. You will know more than your financial planner or financial advisor knows about it. And you'll probably know a damn sight more than your bank knows about it. And that's not a bad place to be when you're going to make a decision to invest, right?
No, and Derek, I'll tell you this. I'm in Dubai this week, and two things are happening. Of course, there's an expo, which was meant to be in 2020, but it was shifted because of COVID. And it is sort of, at least from my vantage point, it's coming of age of Dubai and UAE to join the ranks of developing world with focus on innovation. So they have all kinds of space programs, artificial intelligence, uplifting the community and society. So it's a lot of amazing energy here. But this week is the blockchain week. And so there are close to about 15,000 companies from around the world.
Wow.
So this is all learning, right? Even though I've been doing this for a decade now. Yeah. Every time I go, I learn something new in these spaces, and you simply keep absorbing it. So energy is great, and the innovators, the regulators, the VC community, and the truly global projects are all here this week. And the conversation is exactly the same, that, it is an affirming sort of global phenomenon to me. It's reforming global phenomenon, that there's a general understanding around durability of technology and impact on our society, which I think is a very powerful statement to say this is here to stay. We simply have to make it better. We have to solve the clunky nature of where things are. And surprisingly enough, like for example, in UAE too, this month, because in the preparation for this event, the Financial Services Regulatory Authority and Securities and Commodities Authority, which is SCA and FRCA, and they have something called Dubai Financial Services Agency, are sort of the college of regulators who actually have looked into elements of safe harbor. They're encouraging people to come and develop projects to attract talent. So every country aims to attract talent. So I think I would agree with you that, we all should continue to learn and be, in unison in that space and learn from each other. And knowledge is power. I would completely agree with that.
Yeah. Yep. And in the space, the ability to have early knowledge against the masses is incredibly powerful. So as you know, my 95-year-old father listens to our webinars, and he understands a bit about how this structure and this space works. And he's amazing. The fact of the matter is, I said to him the other day, Dad, you are probably the most knowledgeable 95-year-old in the world in cryptocurrency.
Well, that's great, Derek. Today you made my day, because we have a demographic spectrum from 16 to 95. So we're doing something right, I think.
I hope so. So have a great week. I'll see you next week. And for those that are listening, thank you so much for listening. I hope you've enjoyed it. By all means, suggest topics, suggest questions, write to us by all means. You'll find us at nitin@portal.am, Derek, YCK@portal.am, or just say hello to us on our LinkedIn profiles. And we're delighted to reconnect with you and share some of your thoughts. And I think fairly soon, Nitin, we're going to have some more guests on and add some international flavor to this.
As they say in Dubai, inshallah, which means God willing.
And, God willing.
And what we'll kind of do is try to, so you listed 20 countries, we'll try to go and reach out to some of these emerging economies and get on the ground reality of what people are doing, what people are thinking. I think that'll give us a global perspective on this. So hoping next week we can get either somebody from India or Brazil, because they are some of the fastest growing economies in the space for many reasons, and we'll learn from them on the show. So looking forward to that, Derek.
I look forward to it. Bye for now. Bye-bye, everyone.
Okay. Bye, guys. Ciao, ciao. Bye-bye.